All right, fam. So we have got end of financial year coming in hot, right? Coming in hot. So every year I get a bazillion, maybe four, I get a bazillion messages from people saying, hey, bro, what's some last minute tax things I can do? And every year I say, go fuck yourself. You should have done this 12 months before. And the same people every year do it, right? So it does my head in. So I'm going to give you some tips today on some things that you should be looking at. Some things that we do for our clients on top of the annual tax strategies that us and their accountant work on that you might be able to take advantage of. So you stop fucking messaging me that stupid shit. So, firstly, if your accountant just gets you a tax return every year, a good tax return, that's not a tax strategy. It's rubbish. It's rubbish, right? Go and see Carter's. Go and see Carter's Tax Advisory. Drop me a message, drop me an email. I'll introduce you to the team. They'll look after you. Okay. They'll show you what a real accountant is supposed to do. Yeah. Proactive strategic tax work to make sure you're getting the most you can every year out of the tax system. Now, moving on from that. So, superannuation is the big one. Superannuation is the biggest last minute tax ditch that you can make, right? So we've got two types of contributions. We've got concessional and non-concessional. Non-concessional mean you pay tax before you contribute, and then you contribute the money. You don't get a tax discount for it. There's a bigger cap for that one. We're not going to talk about that today. That's different, right? We're going to talk about concessional contributions, which is the contributions you make pre-tax, right? They're taxed at 15%, comes out of your pay, goes into, like salary sacrifice, goes into there, and then lowers your taxable income. Now, this includes concessional contributions have a cap of 25,000 per annum, and this includes what your employer puts in. So if your employer puts in 10,000 a year, you have a leftover cap of 15,000 that you can contribute yourself. Now, you don't have to do salary sacrifice. You can make a contribution, sign a couple of forms, and then what happens at the end of the tax year, you get a refund because you paid too much tax on that money where you should have only paid the superannuation tax rate, okay? So the concessional contribution is the quickest way to get a big tax deduction if you just got money lying around, okay? Now, good news is this year, from 2018, this year they've allowed a new catch-up rule, which means for any unused caps from 2018 can be carried forward 5 years. Now, when we get past 2023, then it's going to become 2019, 2018 is going to be gone, okay? So from 2018 moving forward, if in 2018, 2019, and 2020, you only did $10,000, or you only did what your employer put in, and that was $10,000. You got $15,000 in each one of those years. That's 45 grand plus this year. Yeah, so that's 60 grand. That's $60,000 left. And the beauty of that, not only can you catch up on shit you missed, is that the tax deduction happens in the year that you make the contribution. So if say, for example, you earn $80,000, yeah, you earn $80,000 a year. And let's just say you've put in $10,000. It should be closer to 8, but let's say you put in $10,000 a year and you've got 15,000 left over. That's the tax-free threshold. Tax-free threshold is $18,200. That's the first lot of money you earn. The first $18,200 that everybody earns is tax-free. Okay, everyone. The next tier is 19%. So $18,200, that first $18,200 you earn is the only money that is taxed lower than superannuation. Superannuation is taxed at 15%. The next bracket goes from 0 to 19% in your everyday dollar. So essentially, if you were to earn $80,000 a year and you use that catch-up rule and you contributed that $60,000, your taxable income this year would only be $20,000, meaning your $1,800 between the $18,200 and the $20,000 mark would be taxed at 19%. Do the math, right? It's like $360 worth of tax. Whereas at $80,000, right, at $80,000 you would be taxed. I'll figure it out. You taxed a fair whack, right? So that's 80 grand's like $1,500 a week, and there's no way you're walking away with $1,500 a week. So the catch-up rule, for concessional contributions is a huge way for you to get a quick last-minute tax deduction. So 80K, you'll pay 15 grand. You'll pay 15 grand in tax, okay? 15 grand in tax, whereas at 50, 60,000 times 15%. You only pay 9 grand by putting into super, right? Cool. So difference is 6 grand better off. 6 grand better off. That's 6 grand for nothing. 6 grand for nothing, and that's unbelievable, right? 6 grand for nothing, and then you boost your super up nicely. So concessional contributions and the catch-up rule from 2018. That's a great way to dump some money in there. The next one is for first home buyers. Okay, if you're a first home buyer, you want to be a first home buyer, you're saving a deposit. Very, very smart to utilize at this time of year to utilize the first home super saver scheme. Yeah, so you dump it in now. 15 grand you're allowed. 15 grand over 2 years per person buying the home, their first home. So there's 2 of you, it's 15 grand each. That's 30 grand. Go in, and if you guys are ready to buy on July 1st, you can take it out and go from there. If you're not ready, you can dump it, and then you get to this time next year, you can dump that money in again, or even whenever throughout the next year, you can dump the money in, the 15 grand, and then you can take 30 grand each out for your deposit. So absolutely genius way to get quick boost in your savings. I think on average, the 30 grand each is worth about $6,000, okay, in tax benefits. So easy way to boost up, 8 to 10 grand extra in your deposit. So if you're not using the first time super saver scheme, that's a really good one to do as well. Just make sure you do the right paperwork and you do it the right way. 15 grand per person straight in this side of the year. And then if you're going to buy next year, if you're still in 2 financial years times, if you're still not ready to buy, you can increase that to 50K. So you can do that over 3.5 years essentially, which is phenomenal. So that's a 50K, so it's 100 grand across a partnership. So first time super saver scheme is a great one as well. The next one's a downsizer contribution. So if you are over 65, next year it'll be 60 based on the proposed budget changes. But if you're over 65, you've been in your house for longer than 10 years and you sell, you and your partner can dump 300,000 each with no questions asked into superannuation. That's 600 grand. That's phenomenal. That's massive, right? It's huge, monstrous. Great boost to someone's account-based pension. That could boost it 30 grand a year. That could take you from 50 grand a year to 80. That's a brilliant boost amount of boosted money. The next big one is for anyone over 50. Anyone over 50, you really need to make sure that you're coming into the twilight years, baby. You're coming in. If your super's not up to scratch, you're running out of time. Time is the biggest contributing factor to your superannuation hitting the number you need, and you are running out very fast. So now you need to be boosting your contributions to the maximum as best as you can to be able to even get within range of being able to retire yourself. Okay. So if you're above 50 and you haven't pulled your finger out of your ass and worked on your super, make sure it's invested correctly. The other thing you got to make sure is, while we're on the topic, even though it's got nothing to do with the financial year, if you're 50 and you've got high growth investments in your super, you got to be aware, which means all your money's invested riskily. You got to be aware that if the market takes a downturn in the next 5 years, you may not have enough time to catch it all back up. So you need to make sure your investments are matching the time frame you have left before you need that money. Very, very underrated thing. People just go, my thing's gonna be fine. If you lose your money in 8 years, if it takes a full dump, you lose 50%, you're fucked. All right. So make sure you're on top of that. Make sure you're contributing and make sure you're aware. Don't just think, she's gonna be right. If you're over 50 and you've never thought about your superannuation, there's a good chance you're not going to be right and you need to get on top of it. If you're watching this and you've got parents who are over 50 and you think they might be that, I can send this to them. Send this to them, because I'm sick of people whinging and carrying on about not being able to retire, and they've never looked at their superannuation, which could have been the easiest way for them to retire now that they're fucking 50, 55 or whatever. Okay. The next one, if you're not 50, you're 20 and you're 30, at least make sure that you're on track with your numbers. Yeah. If you don't know what your numbers are, come become a client or do the calculations. I put a million videos up about how to do the numbers. But if you still can't do it, then become a client and we'll do it for you. But you need to make sure you're at least contributing. Right, $10,000 at 20 years old is worth $500,000 by the time you hit that age. Yeah. $10,000 at 55 is worth 15 by the time you hit 60. Yeah. The compounding effect's massive. So like, if you got to spare, I do this with young clients all the time. They got, they might get inheritance or they get some cash and they might have 20 grand. Just chuck it in. I'm not saying this isn't financial advice, so don't do that. I'm just saying that I do sometimes you just go, just chuck 20 grand in. And then they don't even have to contribute for the next 10 years and it's well on its way to being good to go, right? So you've got to consider some things, it might be a bit of a hard pill to swallow, but you got 10 grand sitting there and you're no chance of buying a house in the next 3 years, and why not? Why not chuck it in there? At least it's going to do something for you rather than just put up your nose over the next 3 years. I know there's an idea, right? But big note is end of financial year. If you haven't done your strategies to now, there's not a lot you can do outside of that. If you're a business owner, you've got the instant asset tax write-off. Potentially, if you're a big business owner and you've looked, you've sold some business assets, you might get the small business CGT concession that you could look at with your accountant. But they're the big ones, all right? If you need any help, drop us a line. We're always here around this time of year. We're going to be flat, Vicky. You've pretty much got till June 20 to do it, but we wouldn't recommend leaving it till June 20. If any of this stuff triggered you and you want to have a crack at any of it, get in touch ASAP, because we're going to be flat out, but you also have a deadline before you just can't make the contribution. They won't receive it in time. So make sure you reach out sooner rather than later and we'll get you sorted.